Hey there, financial navigators. Welcome back to the channel where we demystify the complex world of how to borrow stocks and potential short squeeze plays. Today, we're diving deep into a specific company that's been lighting up our screener with some truly eye-watering cost to borrow fees, NCT Cayman Limited, trading under the ticker NCT. If you've ever wondered what makes a stock hard to borrow and what that could mean for its price action, you're in the right place. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Joe NCT chart. Let's zoom in on NCT, NCT Cayman Limited. This company operates in the industrial sector, specifically within marine shipping. Through its subsidiaries, NCT provides essential maritime shipping services globally, including time charter and vessel management. Interestingly, they also have a hand in processing pulp, paper, and paperboard products. With a market capitalization of just $5.03 million, NCT is firmly in microcap territory. Looking at recent price action, NCT has seen some significant upward momentum. Today alone, it's up plus 3.50%. Over the last 5 days, it's climbed plus 14.4%, and looking back a month, NCT has surged an impressive plus 32.65%. However, it's important to note the volume picture. Today's volume stands at 165,700 shares, which is only about 0.1x its 30-day average volume of 1,679,006 shares. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? At its core, it refers to the scarcity of shares available for short sellers to borrow, typically because existing shares are already heavily shorted or held by long-term investors unwilling to lend them out. When you want to short a stock, you essentially borrow shares, sell them, and hope to buy them back later at a lower price to return them, pocketing the difference. But borrowing isn't free. You pay a fee, known as the cost to borrow, a CTB. This is an annualized interest rate charged on the value of the shares borrowed. A high CTB indicates strong demand from short sellers relative to the supply of lendable shares. And yes, these fees can easily exceed 100% annually, meaning short sellers are paying over 1% of the borrowed stock's value daily just to maintain their position, which can really add up. Why this stock is hard to borrow right now. Highlight CTB 721.5%. NCT, NCT Cayman Limited, has landed on our hard-to-borrow screener with a staggering annualized cost-to-borrow fee of 721.5%. That's not a typo. This extremely high rate suggests significant demand from short sellers who are willing to pay a premium to bet against the stock, or a severe scarcity of shares. With an estimated float of just 0.3 million shares, NCT tightly held nature makes it particularly sensitive to borrow demand. Our internal composite squeeze score for NCT currently sits at 45.4 out of 100, which considers this high CTB, along with other factors like foot size and price momentum. While an exceptionally high CTB can be a red flag for short sellers and a potential indicator of squeeze risk, it's crucial to understand that it doesn't guarantee a squeeze. Sometimes, a high CTB simply signals that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay top dollar to maintain their positions. Squeeze mechanics explained. So how does a short squeeze work? It's a chain reaction. When a stock starts to rise, short sellers, who were betting on a decline, see their losses mount. If the price continues to climb, especially in a stock with a limited float like NCT 0.3 million shares and high borrow fees, some short sellers might be forced to buy back shares to limit their losses and avoid paying those exorbitant daily CTB fees. This buying pressure further pushes the price up, which in turn triggers more short sellers to cover their positions by buying, creating a powerful upward spiral. The shrinking supply of borrowable shares, combined with an increasing number of short sellers needing to close their positions, can accelerate this price surge dramatically. Dilution risk check. When evaluating a potential squeeze candidate, dilution risk is a critical factor. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. Even if a stock has a high cost to borrow, new share offerings can provide liquidity for short sellers to cover their positions without driving the price up, or simply negate any upward price momentum by increasing the share supply. For NCT, our check found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. We also found no recent reverse split for NCT in our look-back window. This absence of recent dilution or reverse split means one potential hurdle for a short squeeze scenario is not currently present, which is generally a positive sign for squeeze hopefuls. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For NCT, with its 721.5% CTB and tiny 0.3 million share float, here's what you'd want to monitor if you're tracking potential squeeze plays. Firstly, continue to watch the CTB fee. Any sustained increase or a sudden jump could signal even more pressure on shorts. Secondly, keep an eye on the actual number of shares available to borrow. While currently unknown for NCT, if borrow availability shrinks further, it intensifies the squeeze potential. Thirdly, look for a significant increase in daily trading volume, ideally surpassing its 30-day average of 1,679,006 shares. A surge in volume accompanying strong price action could indicate short covering is underway. Remember, the current relative volume is only 0.1x average, so any sustained uptick here would be noteworthy. NCT, NCT Limited, with its niche in marine shipping and paper processing, small market cap, tiny float, and the astronomical 721.5% cost to borrow, presents a fascinating case study in a hard-to-borrow landscape. While it certainly meets some of the criteria for potential volatility, remember that high CTB alone is not a guarantee of a short squeeze. It's one piece of a much larger, complex puzzle. Always conduct your own thorough due diligence. If you found this deep dive into NCT helpful, please give us a like, subscribe for more in-depth analyses, and let us know in the comments which hard-to-borrow stocks you'd like us to cover next. Until then, happy trading.